In this video, I will break apart the most popular ETF in Europe so that you know exactly how it works. I'll show you where and how to buy ETFs as a European investor, and I'll highlight the most expensive mistakes that beginning ETF investors make so that you can avoid them. Over my 18 years of experience, both on Wall Street and here in Europe, I've invested hundreds of millions of euros in ETFs and their cousins index funds. I know it can be confusing for beginners because there are thousands of ETFs available and they have long confusing names. You can buy them on dozens of different stock exchanges in different currencies. It is easy to feel lost and never get started, so let me clear that up for you. The best place to find ETFs for European investors is a portal called justetf.com. It's an easily searchable database with over 3,700 ETFs you can buy pretty much anywhere in Europe. So if I go to this database and I sort by size, I see that the most popular ETF among European investors is the iShares Core S&P 500 UCITS ETF USD ACC. Now, in a second, I'll explain what all of that means. But first, let me mention that I'm not making an investment recommendation here, okay? This is simply the biggest ETF in Europe. It's not necessarily the one that is best for you. In fact, depending on where you live and the local tax rules and your goals in life, this could be a bad choice. Later in the video, I'll share a resource which covers how you choose the best ETFs for you. But for now, let's break apart this ETF so that you understand how ETFs work better. And we're going to start with the name. So the iShares Core S&P 500 UCITS ETF USD ACC. The most important part to understand is, of course, this ETF, Exchange Traded Fund. An exchange traded fund is an investment fund which trades on a stock exchange. So first, what's an investment fund? Well, let's say that you want to invest in stocks because you've heard that it's a great way to make your money grow. And that is true. But the problem is there are thousands of stocks out there. And unless you're a professional, it's hard to choose the best ones. So you pool your money with other investors and you give it to a professional manager who will choose the best stocks for you in exchange for a fee. Now that's an investment fund. But why would you put an investment fund on a stock exchange? Well, it's for ease of access. Here in Europe, traditional investment funds are usually sold by banks, and this means that you are stuck with whatever your local bank wants to sell you. Often these are expensive, poorly performing funds. But a stock exchange is like eBay for investments. It's this huge online marketplace which gives you access to thousands of different stocks or investment funds without being restricted to what your bank wants to sell you. So that means you can buy some of the best investment funds in the world, even if you live in a small European country like Latvia or Croatia or Luxembourg. So that covers ETF, but let's go back to the name. So first up, we've got iShares. This is simply the brand name used by BlackRock, which is the biggest fund manager in the world. It's kind of like Audi or Skoda in the car market. And then up next, we have Core. So this is a product category used by iShares. You can basically ignore that. And then we have S&P 500. Now, this, of course, refers to the most famous stock index in the world, which includes 500 of the biggest American companies. Why is a stock index included in the name of an ETF? Well, it's because the vast majority of ETFs are a type of fund called an index fund. Basically, index funds buy all the stocks in a particular market index. And as it turns out, this is a really smart investment strategy. I've got other videos on this topic, but basically with an index fund, you spread your money among hundreds of different companies and you pay a very low cost to do it. As Warren Buffett said, by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. So index funds are pretty smart. And this ETF is an index fund that tracks the S&P 500 index. Then up next, we have UCITS. UCITS refers to a European Union directive. So it basically means that this ETF is regulated in Europe. If you live in the European Union, pretty much all the ETFs that you can buy will be UCITS ETFs. Then we have USD. So this refers to the fund currency. Now, confusingly, just because the fund currency is dollars doesn't mean you have to buy this ETF in dollars. As I'll show in a second, you can actually buy it in euros, but the accounting of the fund is done in dollars. And then finally, we have ACC. Now, ACC stands for accumulating. That's the distribution policy. So what does that mean? Well, an ETF invests in stocks, and many of those stocks are profitable. They pay dividends to the ETF. Now, the ETF has a choice of what to do with this money. It could pay this money out to you, or it could use this money to buy more stocks. A distributing ETF pays money out to investors. An accumulating ETF keeps the money inside the fund to buy more stocks. Now, which is better? It depends on a number of factors, like how old are you? Are you just saving for retirement now, or are you already retired? And also, what are the tax rules in your country? In some European countries like Austria or Switzerland or the UK, these accumulating funds get taxed in a way that makes them less attractive. But in many European countries, they are actually great because all the money stays inside the fund, so you don't have to pay dividend taxes. And if you decide you want a distributing ETF instead of an accumulating one, it's usually pretty easy to find a different version tracking the same index. For example, here we have a Vanguard S&P 500 UCITS ETF distributing. So it tracks the same index, does the same thing, but it's a distributing fund. As you can see, these local details can get complicated quickly. That's why I put together a step-by-step training program for ETF investors in Europe. In this training, I cover questions like, how do you pick a good ETF given your goals and the country where you live? Which investment app or brokerage do you choose, and how do you handle taxes? If that sounds interesting, just follow the first link in the description to find out more. But going back to our iShares fund, on the next line we see something really important, which is the ISIN, the International Securities Identification Number. This is a unique combination of letters and digits that identifies the ETF. Sometimes it can be difficult to look up an ETF on a brokerage website or some other database. There can be a lot of ETFs which have a very, very similar name. They might also be an iShares ETF that invests in the S&P 500, and it's hard to figure out which one is the right one. In that case, you simply copy the ISIN and you search using the ISIN. So for example, on Google, you can search by ISIN and use that to find the official website for this fund, which can be helpful. You might ask, why not use this website to do this video instead of looking at justetf.com? Well, the problem is different fund managers have different website formats, and some of them are really difficult to use. So I prefer to use Just ETF because it centralizes information in one place. And then once you have decided that, yes, this particular ETF is something that you want to buy, of course you want to go to the official website as well and verify all the information. And then moving on, we have the TER, the total expense ratio. Jack Bogle, the father of index funds, had a famous saying, you get what you don't pay for. The more you pay in fees, the more money goes out the door, the less is left in your account. One of the best things about ETFs and index funds is that they have low fees. The typical investment funds sold by your bank here in Europe, they charge you 1% per year, even 2% per year or more. But ETFs and index funds tend to charge 0.07%, 0.1%, maybe 0.2% per year, which is much, much less. It leaves more money in your account. Okay, we already covered distribution policy, but now let's look at replication. So for this ETF, the replication method is physical. What does that mean? Does that mean that there's some kind of physical mechanism moving gears and levers to invest your money? Well, not quite. What it actually means is that this ETF will go out into the market and buy the 500 stocks included in the S&P 500. By contrast, there are some ETFs that are called synthetic. For example, here is this Invesco S&P 500 UCITS ETF, which is a synthetic ETF. This ETF will not buy those 500 stocks. Instead, it's going to use some financial wizardry involving what are called swaps to deliver investors pretty much the same result. Now, which is better? Well, it depends what you are prioritizing. When it comes to investing in American stocks, because of tax reasons, these synthetic ETFs actually tend to get better results. Basically, you don't have to pay dividend taxes. So for example, when we go down to performance here and look at 5-year performance, this synthetic fund earned 111.8%, but this physically replicated fund earned 109.8%. So a couple percentage points less over 5 years. So synthetic funds have some tax benefits, but because they are more complicated, they are considered a little more risky. In really extreme market crashes or difficult situations, potentially you could have some problems with these synthetic ETFs. I say potentially because in practice, this has never really happened to any meaningful extent. That said, a lot of people do prefer physically replicated ETFs because you know what you're getting. The fund will actually use your money to buy the underlying shares. Next up, we've got fund size. So this is the biggest in Europe. It's actually got 117 billion euros invested in it right now. Is fund size important when choosing investments? In some cases. If the fund size is over, let's say, 100 million euros, I don't really care about it much. But if I see an ETF which has maybe 5 million euros invested in it, I tend to be careful because there's a big risk that the fund manager might shut it down. Fund managers launch ETFs to make money, and if nobody's buying it, they're not making any money, so that means they might shut the fund down. Now, it's not a huge problem. The money just gets returned to you in that case, but in many European countries, you have to pay taxes if you have a profit at that point. So for that reason, I prefer funds which do have a larger size, but there's certainly no need to have a fund which has billions and billions invested in it. That is not really a significant advantage. And then we have the inception date, which in this case is 2010. Sometimes people ask me, is it a problem if a fund was launched recently, maybe in the past year? My view is always, as long as the fund size is already significant, and as long as the fund provider has a good reputation, it's not some kind of new company, then I'm fine with new funds. Of course, if you have a longer track record, you have more data that you can look at in terms of historical performance and how the fund has tracked the index. We'll talk about that in a second. But on the whole, having a new fund is perfectly fine most of the time. And finally, you have the number of holdings. And this is something that confuses a lot of people. Why do S&P 500 ETFs have 503 holdings, not just 500? Well, it's because a few companies included in the index, like Alphabet, the parent company of Google, have two share classes in the index. So it's basically the same company with two different types of shares. So that covers the foundations. Now let's move on to the section overview. And here we have a quote. So this is the latest price of the ETF. So this ETF currently is trading at around 618 euros per share. How important is this? If you see one ETF that has a price of 100 euros and another ETF which has a price of 600 euros, should you prefer the one with the biggest price or the smallest price? Well, that's kind of a trick question. It really doesn't matter that much. The price of an ETF is simply a unit of measure. You know how you can buy sugar that's packed in 1 kilo bags or 5 kilo bags? Well, you can buy the S&P 500 in 100 euro pieces or 600 euro pieces. It doesn't really change the performance. That said, these large ETF prices can be a disadvantage if you have a brokerage which doesn't allow what are called fractional shares. So basically, if every time that you invest your money, you have to buy at least one full share, that means you have to invest at least 600 euros in this case. So that can make ETFs with lower prices a little more practical for people. Then on the right-hand side, you have the description of the ETF. That's certainly very useful to read to understand how it works. And then down here, you have some documents. The most important document is certainly the KID, the Key Information Document. I'm a big fan of this document because it's a standardized document which all fund managers have to make in the same way. And for many complex and expensive investment products that we get sold in the European Union, it's basically the only place where you can get an honest look at the true costs, the true fees of the investment. Now, for ETFs, it's usually not so essential because the fees are usually low and transparent. But for other investments, you always want to open the KID and scroll to the third page where you can see this table of total costs and the annual cost impact. In this case, it's 0.1% per year because they rounded up 0.07% to 0.1% per year. There's also some other useful information in the KID, for example, the risk indicator, where 4 or 5 is typical for stock funds, and maybe 2 or 3 or 1 could be for bond funds or money market funds, which are very low risk. And then you have all kinds of structured or leveraged products, which have an indicator of 6 or 7. All right, so next up, we've got a chart of performance. So how has this ETF done over time? Now, something that is really important to understand about ETF performance is that these charts and performance numbers, they include everything. They include the price going up or down. They include dividends if you have a distributing ETF, and they also include fees. So these are the results after all the fees have been subtracted. So this chart shows us that between 2010, when the fund started, and today, the increase in value for somebody who put money into the fund would have been 710%. So that's a pretty crazy amount of profit you could have earned by investing in this fund between 2010 and 2025. Now, what is a critical mistake that a lot of beginning investors make is to pick ETFs based on these historical results. For example, people will play with this tool to add other ETFs for comparison, maybe a popular MSCI World ETF, which invests in global stocks and developed world stocks. And they will say, well, the S&P 500 did much, much better, so I'm going to buy this one instead of the more diversified global ETF. But the problem is, past results don't guarantee the same performance in the future. In fact, historically, it has often been the case that one region performs really well for a decade or two and then it underperforms. So looking at historical data is a really, really bad way to pick funds. In fact, if you always pick the most profitable funds based on history, you will probably not get the best results, because that means you are buying funds which are right now kind of hyped up and expensive, as opposed to funds which are maybe a little less popular where you could jump in at lower prices. So do look at the history to understand how the fund works, but don't choose ETFs based on which performed the best over the past X years. So let's keep going down. We have a few more basics here. So we've covered most of this data, but what is important here is the strategy risk. So here it says long only. That means this ETF simply puts your money into stocks. You will also see some ETFs which are leveraged. So that means they borrow money to invest in stocks, or which are inverse. So if the index goes up, the ETF goes down. You should stay away from those unless you really know what you're doing. Those are really, really risky. Then under sustainability, this says no. There are many ETFs these days which pay attention to issues around social responsibility or climate or corporate governance. Those ETFs usually have the acronyms SRI or ESG in the name. This fund doesn't. This fund invests in the whole market. Then we have the fund currency. We already addressed that. And then we have currency risk, which says currency unhedged. What that means is, if you are an investor based in the Eurozone or based in the UK, where the local currency is the euro or the pound, then you will have currency risk between the euro or the pound and the dollar, because this fund invests in dollars, it invests in American stocks. There are some ETFs which are hedged, so they remove this currency risk. But that is not quite as wonderful as it sounds. There are significant drawbacks and costs associated with that. Most experts don't really recommend hedging long-term stock investments, but if you are concerned about currency risk, it is available. It is possible. Next up here, we have volatility. Volatility is a fancy word for risk, specifically short-term risk. How much does the fund go up and down? 19% is quite a lot. For stocks, maybe 15 to 20% is kind of a typical range. As a stock investor, you should expect that your profits will change dramatically from year to year. Maybe one year you make 9% per year, the next year maybe you make 30% per year, the next year maybe you lose 15%. That is completely normal. Stock ETFs go up and down quite a lot. And then we have one technical piece of information which is actually quite important. It's the fund domicile, in this case Ireland. So as investors based in Europe, we cannot buy ETFs which are legally established in America, like the big popular ones like SPY or QQQ that American YouTubers talk about. We need to buy ETFs which are legally established somewhere in Europe. Most ETFs available are based either in Ireland or Luxembourg. Both can be fine, but when investing in American stocks specifically, Ireland has some tax benefits. So usually people go for Ireland-based ETFs when investing in America. Unless it's a synthetic ETF, in which case it doesn't matter. And now you see why investing from Europe can get a bit tricky. There's all of these little details that you don't really realize until you get deep into the weeds. All right, and now we get to a really interesting section, which is holdings. What is included inside of this ETF? On the left-hand side, we have the individual holdings, the companies that the ETF invests in. We see that the biggest investment right now is NVIDIA, which is 7.7%. Then we have Microsoft at 6.9%. We have Apple at 6.3%. And basically, the top 10 holdings actually make up 38% of the whole ETF. For a lot of investors, this is quite stressful. It used to be that if you buy an S&P 500 ETF, you get a lot of diversification. Your money gets split among many different companies, just a few percent in each company. But today, with these giant US tech companies, you have a huge amount of exposure to a couple of major companies. And if those companies get into trouble, the whole portfolio can get affected. So this is one reason why a lot of investors are interested in alternative strategies instead of just buying the S&P 500, whether it's geographical diversification or maybe looking also at small cap stocks, which are smaller stocks and don't have the same problem. And we see the same kind of concentration issue over here where almost all the money is invested in the US. In fact, I think this 96% data from just ETF is not correct. It's pretty much going to be 100% in the case of this ETF. And that means that all of your money is invested in companies that are listed on American stock exchanges. Now, these are in many ways global companies that have customers and income from all over the world. That said, you are very exposed to companies which are based in America. And a lot of investors these days do prefer to take a more diversified approach where maybe you invest in developed world stocks or also some emerging market stocks. And we'll talk about how you can choose that kind of strategy a bit later in the video. But okay, so this covers the holdings. Now, up next, we have some information about different savings plans offers from different brokerages, but this is mostly marketing stuff by Just ETF. I would not pay much attention to that. Then you have a section on performance. So this is again, like the chart, about historical performance. You can see how the fund has done over a period of several years. Now, this is not annualized, so this is not like 9% per year, 11% per year. This is cumulative. So for example, this ETF has gone up 58% over 3 years, or 710% since inception. As I mentioned before, this can be interesting to look at, but don't go choosing ETFs just based on the historical performance. Okay, and the final section I wanted to bring your attention to is the stock exchange listings. This is a very important practical aspect of buying ETFs. Basically, you can buy the same ETF on different stock exchanges, different online marketplaces for investments. It's kind of like you can buy the same book on Amazon.com or other online bookstores. You can choose where is more convenient for you. And the same ETF can be available in different currencies on different stock exchanges. So for example, I'm based in the Eurozone. I would like to buy this ETF in euros, but maybe you are based in the UK and you want to buy it in pounds. So you can find where it's available in this table. For example, if you want it in pounds, you would probably buy it on the London Stock Exchange. GBX as the trade currency means that it's listed in pennies, so that would make sense. You would use this ticker, this symbol CSP1 to buy it. I want to buy it in euros, and with euros I have more choices. There's GetX, there's the Stuttgart Stock Exchange, Borsa Italiana, Euronext Amsterdam, and we also have Xetra. Now, Xetra is the biggest stock exchange for buying ETFs in Europe, so if I have a choice, that is what I usually prefer. In fact, let me now move on and show you how to buy this ETF on Xetra. We cannot directly go to the Xetra website and click buy. So for example, if I look up the German Stock Exchange, which is the home of Xetra, I put in the ISIN of this ETF and I look it up, I can get all kinds of interesting information. And there's even this beautiful button, buy or sell. But when I click that, it's going to tell me to use some kind of brokerage or bank to do it. You cannot do it directly through the stock exchange. So the question is, which brokerage or investment app is best for buying ETFs? This is actually quite an important question because your brokerage, it's not just a supermarket that allows you to buy investments. Your brokerage will also hold on to your investments. So it's really important that this needs to be a safe, reputable, licensed company. Now, some of the biggest names in Europe that a lot of investors use are Interactive Brokers or Saxo or DeGiro or Trade Republic or Trading 212. But the thing is, there is no single brokerage that is best for everybody. A number of factors that you need to consider are, of course, safety and license. You want a company that is financially strong and that it's licensed in a country with a good financial regulator. Product access. Make sure that the brokerage offers the ETFs that you want. This can be a problem, especially if you live in Eastern Europe, because many Western European brokers don't offer a lot of ETFs to Eastern European clients for various regulatory reasons. You have to look at costs, make sure the fees are low, and then you have to think about taxes, because in many European countries, it is better to use a local brokerage that simplifies taxes. In particular, this is the case in countries like Germany and Austria and Denmark. For doing a quick demonstration, I will use Trading 212. It's not my main brokerage, but it is very simple, so I like using it for demonstrations. Okay, so let me open up Trading 212. Like any brokerage, when you log in, it gives you a lot of different information. I see information about top winning stocks, top losing stocks, all this other stuff. It doesn't really matter to me. That's like noise. It's mostly for traders. As a long-term investor, I just want to buy my ETF. So I'm going to hit search and I will paste in the ISIN. And immediately I see several places where I can buy this ETF. Now, because I put in the ISIN, this unique identifier, I know that I have the right ETF. But the same ETF can be available in different currencies, right? So here I have it available in dollars, in pounds, or specifically in pennies, or in euros. Because I'm in the Eurozone, I'm going to buy it in euros. So I'm going to go here and hit buy. Now, I don't actually want to put 600 euros into this ETF today. And the good news is that Trading 212 offers fractional shares. So that means I don't have to buy one whole share. I can buy part of a share. So I'm going to tell Trading 212 to give me 0.1 share, which is around 62 euros. And I will use what is called a market order. Now, normally when I teach my full investment training classes, I recommend limit orders. That is how you can make sure you get the best possible price. But for simplicity right now, I'm going to use a market order. So I put in 0.1, I hit review order, I look everything over, and I hit send buy order. And pretty much instantly, Trading 212 tells me I bought 0.1 shares at 617 euros 67 cents. So basically, I invested my humble 60-something euros in 500 of the biggest American companies with just a few clicks in just a few seconds, which is kind of crazy when you think about it. I mean, 100 years ago, the richest person in the world couldn't do it, but today that's possible for any of us. Okay, so that's how you buy an ETF. But please do remember, depending on your goals, and especially your local tax situation, the ETF that I showed you may not be a good choice. In some cases, it could be a bad choice. This brings me to the most expensive mistakes that beginning ETF investors tend to make. Mistake number one is not customizing your portfolio for your local tax rules. The most famous example, of course, is accumulating versus distributing funds, where in many countries, accumulating funds are best because you don't pay dividend taxes, but then you have these complications in Switzerland or Austria or the UK. Then you have things like Spain, where there are special tax advantages to traditional index mutual funds that you don't get if you invest in ETFs. Then you have something like Denmark, where there's a really complex tax code for different kind of ETFs like distributing versus accumulating. You get very different treatment. If you want the best possible results, you really have to adjust for the local rules in your country. Then the mistake number two would be not adjusting your portfolio for your age and your goals. If you're just 20 years old and you're starting out, you have a long time horizon ahead of you, you're okay with taking risk, well, maybe it makes sense to put 100% of your money into stock ETFs. But you have to be aware that if there is a crisis, stocks can fall by half. They can stay down for years. And that's fine when you're young and you have a lot of time, but it's not okay when you are closer to retirement. So older investors might want some lower risk investments. For example, a mix of stock and bond ETFs. And of course, mistake number three is just buying the S&P 500. Now, it's not always a mistake. If you decide that this is the correct strategy for you, go for it. But today, with the rather crazy politics that we're seeing in the US, and with the huge concentration of the market in big US tech stocks, many European investors are asking, do I really want to expose all of my portfolio to just this one country and this one political system? Yes, over the past 10 or 20 years, the S&P 500 has been a fantastic investment, but that doesn't mean that going forward, betting everything on America is necessarily the smartest approach. You can invest globally, including America. You can invest in countries excluding America. You can focus on Europe. You can focus on emerging markets. You have to consider your personal philosophy, what risks you would like to avoid, and then design a diversified, low-cost portfolio that you can live with long-term. So, as we've seen, buying an ETF is pretty easy, but choosing a smart strategy for investing your life savings can be a little bit tricky. Beginning investors face a lot of questions like which broker or investment app should you trust with your money, and when is the right moment to start? Should you invest all your savings at once or split them up and invest over time? And how do you handle taxes? Because of all this, many new investors either never start at all or they jump in and make expensive mistakes. Now, on this YouTube channel, I help European investors figure all of this out one video at a time. But if you'd like a faster step-by-step solution that takes you from A to Z and also includes some one-on-one support from me, you might be interested in my training program for European investors, the Index Masterclass. So if you'd like to find out more, just follow the first link in the description of this video.